Hello, everyone, and welcome to the webinar on exchange traded funds. It's probably in many ways not my traditional way of presenting, because I will be presenting on a whole lot of regulatory changes, which typically, is a very dry form of presenting. But the implications of what I am going to be presenting for savers in South Africa are absolutely tremendous. And I think it's important that we all look at the details of what has happened in order to fully understand the background to it and what the future holds going forward. But the future for South African savers will never be the same. Just one disclaimer right at the beginning, and that is that what follows are opinions which are based on legal advice and a formal legal opinion obtained from an expert pension funds lawyer working for one of the top 4 legal firms. So these are not my opinions. And the statements that you see coming out of Sygnia are not signed by head of distributions or head of sales. Whatever statements you hear are statements which originate from a very lengthy legal opinion, which we obtained 2 weeks ago, immediately after the new ex-con circular came into effect. Whatever I say is obviously not meant to constitute personal financial advice. You do need to consult a financial advisor regarding your own personal circumstances and how you should treat this legislation in the context of your own personal affairs, because don't forget, everyone is different. Risk profiles, ages, your debt levels, your risk appetites, your amount of savings all vary. Just to quote Life of Brian, Monty Python, you are all individuals. So without further ado, let me move on to the next slide, which doesn't want to. There we go. The most important thing is that I think we've got to recognize that this pandemic is an existential crisis facing humanity as it stands at the moment. Things will not go back to normal for a very long time, if ever, and who is to say what the new normal looks like? We certainly are not going to see a V-shaped recovery. Unemployment levels are rocketing and they will stay high for a prolonged period of time. In terms of sovereign credit ratings, I actually put that slide together last week ahead of the credit ratings that came out on Friday and over the weekend. Sovereign credit ratings might be cut again, which basically means that our cost of new debt that government will be rolling over will be much higher. It also means that the rand will remain volatile. And the only thing that's saving the rand right now is the fact that yields worldwide are negative, interest rates are negative, and consequently international investors are investing in emerging markets on the search for higher yield argument. So it's just an arbitrage around interest rates. And that is why you have seen actually the rand not reacting to the credit rating downgrades. And incidentally, the level of the rand is pertinent to what I'm going to be telling you in terms of regulatory changes. We have seen asset price dislocations in the market between oil, the gold price, and the price of Bitcoin. And yet I'm not yet at the point where I want to go back into investing in Bitcoin. We have seen unprecedented levels of quantitative easing worldwide, negative interest rates being sign of it, as governments basically deploy printing presses and throw all the money available at it. I think we have all seen awful corporate news coming from the corporate sector that will continue. There might be some economic recovery next year, but it's going to be a slow and painful road. I think we all prepared for increased taxation and wealth redistribution, and that's not only specific to South Africa. Someone has to pay for this tremendous amount of quantitative easing that's going on in the world. We note that the South African economy is in a bad state, and we do know that Regulation 28 may well be amended in order to raise money to fund COVID-19 expenditure. But given what has just happened, I think that a lot of us will be a lot more tolerant of any such amendments going forward. And again, I will reference that just now. And one other point, you might have seen that tax havens like Mauritius are using this opportunity to market themselves to the wealthy. So, people are trying to and are going to try and find loopholes to escape paying higher taxes. So South Africa, to recover, requires a new paradigm. And in fact, if you look at the medium-term budget policy statement, it actually delivered just that, a new paradigm. And to quote Tito Mboweni from his speech, today we announced further steps to make cross-border business easier, including inward listings, loop structures, and corporate foreign borrowings. Work is well advanced to modernize the cross-border flow management regime to support South Africa's growth as an investment and financial hub of Africa, for Africa. No one paid much attention to his words when he delivered his speech until the next day, when on the website of the Reserve Bank, and you can confirm this yourself, there appeared in among a list of exchange control circulars, Exchange Control Circular number 15, 2020. And the most important sentence in that circular stated the following: all the remaining foreign classified debt and derivative instruments, as well as exchange traded funds referencing foreign assets that are inward listed on a South African exchange, traded and settled in rands, will be reclassified as domestic. Now, it's a lot of verbiage and it's a lot of complex verbiage, and I will try to unpack it and make it as simple as possible in what follows. But I will also make references to various pieces of legislation so that you can feel comfort that what I'm saying is correct and that it isn't something that we are just telling you in order to market Sygnia's products. The same exchange control circular also said that the following entities qualify to list inward listed instruments on South African exchanges, and that is collective investment schemes registered under the Sysca Act, and Sygnia Itrix is one of such collective investment schemes. So the Exchange Control Circular fully recognizes that domestic collective investment schemes, so Menco companies, unit trust companies, can list these ETFs referencing foreign assets on South African exchanges. And then another very important statement: the following entities may invest in inward listed instruments without restriction: South African institutional investors, South African companies, trusts, partnerships, and private individuals, immigrants, bona fide non-residents. Now, I'll talk about each one of them in particular just now, because there is a reason for each and every one of those entities to be mentioned. But put at the back of your mind the statement made by South African Reserve Bank that those 4 groupings or entities can now invest in ETFs, and I'm going to, for ease of everyone's sanity, I'm going to refer to them as foreign ETFs, in foreign ETFs without restriction. That's what Reserve Bank says. Moving on, this is probably the one slide that I actually want you to remember, because what follows next is a lot of verbiage and a lot of legal verbiage, where we make the arguments for what's on the slide. But this is, in a nutshell, what has happened for institutional investors. And institutional investors include retirement funds, retirement annuities, and preservation funds. So basically what the Excon Circular has done is it has taken ETFs referencing foreign assets. So as an example, Sygnia Itrix S&P 500 index tracking ETF. And it has moved those ETFs, physically moved them from the foreign investments bucket to the domestic investments bucket. So if you look at institutional investors, and different limits apply to for instance, Mencos and to life insurance companies, but just looking at institutional investors. So again, remember your retirement annuities, retirement funds. At the moment, you are restricted to 30% investment offshore with another 10% in Africa. And that is a limit that is set by the Reserve Bank as it stands at the moment, but could have been set by FSCA. I'll explain that. And hence, by definition, 70% of your assets are domestic. Now, what has happened is that foreign ETFs have been reclassified as domestic investments and literally shifted out of the 30% limit to the 70% limit. So nothing that anyone can do about these foreign investments can now impact on foreign ETFs. Foreign ETFs will have to be treated as its own animal, its own instrument, which is actually determined to be a domestic instrument. So foreign exchange limits no longer apply to these foreign ETFs, which are classified as domestic. And I have seen commentators, and there are commentators and commentators. I wish people read Regulation 28 before they commented, and maybe then before they commented, asked for expert interpretation. There is a part of Regulation 28 which requires application of look-through to various instruments. And the idea always was, perversely enough, so that people don't wrap foreign instruments in some kind of a domestic wrapper, a debenture, and then pretend that it's actually a domestic instrument. But there is a clause in Regulation 28 which qualifies this look-through principle. So Regulation 28 says look-through must be applied. So you must look at, if there's a wrapper, you must look at what's underlying the wrapper. But what Regulation 28 also says is that the application of the look-through principle in the context of disclosure of foreign assets must be done in accordance with conditions set by the SARB. The look-through may not be used to undermine or conflict with the conditions set by the SARB. And the SARB has just said that foreign ETFs are now domestic assets or domestic instruments. And the SARB has just said that institutional investors can invest in these without restriction. So in the context of look-through principle, to actually try and reclassify these domestic instruments back to being foreign would be contradictory to Regulation 28. So if nothing else that you take out of this is the gist of the entire presentation. What I'm going to talk about going forward is to show you that this is in fact the fact, and that there is a lot of supporting evidence in legislation itself which talks to exactly these points. Now, first of all, I know that some of you on this call might still not understand what an exchange-traded fund is, and what is the difference between an exchange-traded fund and a unit trust. So an exchange-traded fund, I mean, the simplest way of thinking about it is it's an index tracking fund, passively managed, but it's actually a unit trust, which is listed on the Johannesburg Stock Exchange, such as I've made the reference to Sygnia Itrix S&P 500 index tracking fund. So it's a unit trust subject to fiscal laws, as well as a share listed on the JSE. Now, what are the advantages of ETFs over traditional unit trusts? So for instance, in Sygnia's case, we run our fourth industrial revolution global equity fund, both as a unit trust and as an exchange traded fund. So the advantages of exchange traded funds are that they trade continuously through the day. So you can implement your investment strategy instantly. Whereas with a unit trust, the money is invested once a day based on 3 o'clock in the afternoon pricing in the market. In order to invest in ETFs, you can use certain platforms, certainly Sygnia, Easy Equities, and Cetrix, or a standard stockbroker account. Liquidity on the JSE is always guaranteed. So it's not the same as, some small cap listed shares where you can't sell, or you want to buy 100 shares and you can't buy 100 because there are no sellers. What exchange traded fund providers have to do is they have to appoint a third party called a market maker, and I always talk about them as buyers and sellers of last resort, and they have to guarantee liquidity. So if you want to sell in whatever quantities, you will always be able to sell your ETF, and if you want to buy in whatever quantities, you are guaranteed the ability to purchase as many ETFs as you wish. As I mentioned, SISCA rules apply because an ETF is a unit trust. The disadvantages of a traditional unit trust is that you've got stockbroking charges, and also because it's a listed share, it does tend to fluctuate with forces of supply and demand. So unit trusts are always priced at the actual market value of the underlying holdings. ETFs, you might have small discrepancies, but really those discrepancies in the bid offer prices in what you are buying and what you are selling at are not actually materially different to the market value of the underlyings, but there might be some small differences. And just because this is a Sygnia presentation, I just wanted to point out that we do not charge a platform fee for investments in our unit trust. That's on Sygnia Alchemy Lisp. But with respect to Sygnia Itrix ETFs, because there are some friction costs in the equation, and we have to use a stockbroker to access the ETFs, where the management fee for an ETF is 0.4% per annum or less. We do charge a platform fee of 0.2% per annum for investments under 2 million, 0.1% per annum for investments over 2 million. So it's still much, much lower than many of our competitors. Now, let's look at examples of exchange-traded funds referencing foreign assets. So in our stable, where we manage 23.7 billion rand in such ETFs, and we are one of the two largest providers on the JSE between ourselves and Cetrix, you can select between funds. We track the MSCI World Index or the Euro Stocks 50 Index, MSCI Japan Index, US Index, FTSE 100 Index, S&P 500 Index, Global Property Index Fund, as well as a very popular Fourth Industrial Revolution Global Equity ETF. So all these exchange-traded funds that you're seeing on the screen right now are domestic assets. They fall into your 70% allowance, no longer into your 30% offshore allowance within your retirement annuity preservation fund or retirement fund. And we are in the process of launching some exciting ETFs in February next year. And Iva, who is the head of investment consulting, will take you through that after I'm done with my boring part of the presentation. So let's go back to the legislation, and let's go back to the ex-con circular and who it affects. So as I mentioned, it listed different categories of investors who can now invest in these foreign ETFs classified as domestics without any restriction. So institutional investors are actually defined by the SARB circular, which was issued in September, Circular 9, 2020. And institutional investors are defined as pension funds registered under the Pension Funds Act. So that's retirement funds, preservation funds, RA funds, retirement annuities, life insurance companies licensed under the Insurance Act, collective investment schemes managers, as well as asset managers, discretionary FSPs with a category 2 or 2A license. The other category, so institutional investors, all these entities can invest in these ETFs and treat them as domestic assets. Other category of investments are trusts, companies, and partnerships. Now, in terms of previous legislation, they could not invest offshore at all using their own assets. They could purchase offshore capacity from other institutions who had that capacity available, but and some did, some didn't. So it's a big change for trusts, big change for partnerships. And now, immigrants and non-residents. And you might wonder, why are those two mentioned? And I think it doesn't come as any surprise to anyone that we have seen an enormous amount of financial immigration out of South Africa, particularly IFAs on the skull, and people become non-tax residents in South Africa. And part of it is our own stupidity. Again, new tax legislation, which came into effect in March 2020, which basically means that any earnings over 1 million rand that people earn offshore a double tax in South Africa, which basically meant a whole lot of people who were very happy earning some money offshore, some money in South Africa, and living in South Africa, decided to formally tax emigrate. And then once you tax emigrate, financially emigrate. And with financial immigration also came this dispensation that you can move, well, never mind all your assets offshore, you can move your retirement annuity offshore. So I think part of the reason why the circular has been issued is to basically to say to people who are contemplating financial immigration or who have become non-residents that they can leave their money in South Africa. They don't have to move their money offshore, and they can still invest in overseas instruments and gain offshore exposure. So you don't have to withdraw your retirement annuity, which is, generally to the detriment of most people accumulating savings for retirement. You can retain your retirement annuity in South Africa, and you can invest, given that you're now living offshore, or at least for part of the year, you can obtain 100% offshore exposure within your retirement annuity. So it's a mechanism for encouraging people not to break ties with South Africa, to actually stay in South Africa, or even if they have moved overseas because of the political or economic situation in South Africa right now, not to take that final step of moving all their money offshore and breaking all ties with South Africa, which means that the likelihood of them coming back is so much lower. So this is very, very intentional. There is nothing that is ambiguous about the circular. So what does it achieve? Just again, reinforcing what I've said before, we have taken these ETFs referencing foreign assets. We've moved them from the foreign asset bucket to the domestic asset bucket. And it basically means that all those investors can now invest in such instruments with no limit. So theoretically, you could invest 100% of your retirement fund, 100% of your retirement annuity offshore, utilizing these ETFs for 70% of your exposure, or for 100% of your exposure for that matter. You could have a portfolio made up of these foreign ETFs, and that portfolio would be regarded as being invested 100% in domestic instruments. So these foreign ETFs no longer fall under the limits placed on foreign investments because they are not foreign investments. They are now domestic assets, and the limits on foreign investments remain intact. So nothing has happened to foreign investment limits. The 30% remains the 30%. It's just that these ETFs are no longer classified as foreign investments. But please don't take our word for it, and this is where I get into a little bit of legalese. I'm going to reference you to the word of one of the top pension funds lawyers in South Africa, who works one of the top 40 firms, legal firms. And he really is an expert on the field, in the field of Regulation 28. And that is the first person we called when this ex-con circular came out, in order to give us interpretation of both the ex-con circular and its relevance in relation to Regulation 28. So what exchange controls regulations currently say, and exchange control regulations are enforced by the Reserve Bank. And they provide that all institutional investors, subject to prudential limits in respect of foreign exposure, may invest funds offshore up to an applicable prudential limit. So that's your 30%. Compliance with the prudential limit does not preclude an institutional investor from also having to comply with any relevant prudential regulation as administered by the FSCA. So what that first sentence says, bear that in mind, is that SARB is not the ultimate authority on foreign exchange controls. FSCA has the right to override SARB when it comes to foreign exchange controls. It never has done so, but it does have that right. But again, bear in mind that these ETFs referencing foreign assets are no longer foreign instruments. So although FSCA has the right to prescribe foreign exposure limits, these ETFs now fall into a domestic bucket. So they would have to do something else rather than look at foreign exchange limits. Now, Regulation 28 defines a foreign asset as an asset that is deemed foreign by the South African Reserve Bank and subject to conditions as may be prescribed. And then it says the aggregate exposure to a foreign asset must not exceed the maximum allowable amount that a fund may invest in foreign assets as determined by SARB, or such amount as may be prescribed. And then when you look at this definition of prescribed, it basically makes reference to the FSCA. So FSCA can prescribe. But read the first sentence. Regulation 28 defines a foreign asset as an asset that is deemed foreign by SARB. That's great. These ETFs referencing foreign assets are no longer deemed foreign by SARB. They are deemed as domestic assets by SARB. So again, reinforcing the fact that these ETFs no longer fall under the foreign allowance limit. Now, when it comes to FSCA, how does FSCA communicate prescription? So, SARB issues ex-con circulars. Now, FSCA can do two things. They can publish a notice on official website, unless the change that they want to make is so substantial that it actually constitutes a change of legislation and it needs to be gazetted. But when it comes to, so that's what the word prescribes means. But what is interesting is that, FSCA has never, ever waded in on the foreign exchange control limits set in South Africa. They have always followed whatever SARB has determined foreign exchange controls to be. And, I remember, very few people know it, and it's many years ago, so 16 years to be precise. I was part of Actuarial Society of South Africa's council and part of at that stage, FSB's committee, which was tasked with redrafting Regulation 28. So the current version of Regulation 28 came from that committee. And I remember very long debates at FSB, which basically revolved around the fact that FSB will never override SARB on foreign exchange controls, that foreign exchange controls are something that is set as part of a broader national policy framework, and it is set by the Reserve Bank in consultation with National Treasury, and FSCA will merely enforce foreign exchange controls. It will not set foreign exchange controls. And that has actually borne itself out in the actions of FSCA ever since. So Regulation 28 does not say there is a 30% limit on investments offshore. It basically refers to prudential limits, and that's the verbiage, which basically are determined either by SARB or by FSCA as might be prescribed. And then the way the actual limits are communicated, that 30%, and before 30%, there was a 5% and a 10% and a 25%. It's actually communicated by FSCA through information circulars. And the last information circular they published was in 2018, and they published it on their website, as they are obliged to do, but they didn't prescribe the 30% limit. All they did is they published an information circular referencing SARB's exchange control circular, number 7, 2018, which states that pension funds may acquire foreign exposure up to a revised limit of 30%, So FSCA, since its inception and since inception of foreign exchange controls, has always deferred to SARB on the issue of foreign exchange controls. It has never tried to, and again, I'll reference it in a second, it has never tried to override the SARB on this issue. But again, this limit has not changed. The 30% limit has not changed. All that has changed is that these ETFs, foreign ETFs, are no longer fit or fall under that 30% limit. So now what we have is the fact that they fall under the remaining 70% allowance. And I know I've already made the statement, but I want to unpack it in a little bit more detail, this issue of look-through, because that is what is being quoted. And I've seen some of asset managers putting out some fairly irresponsible circulars to the investors, all signed by head of retail distributions and marketers. Somehow I haven't seen a single note put out by an asset manager which was signed by the head of legal division that can actually interpret legislation. It's always marketing force, distribution force. So let's look at the look-through principle. Certainly, Regulation 28 does require institutional investors to apply look-through principle to each investment they hold. So basically, imagine holding a unit trust. When you're assessing whether that unit trust is compliant with the requirements of Regulation 28, you need to look underneath the bonnet. And you need to do that in order to determine compliance with specific issuer and asset category limits. So remember what Regulation 28 is. There is preamble to Regulation 28, which sets out a whole lot of qualitative conditions, such as, the trustees need to act in line with their fiduciary responsibilities. They need to take members' interests into account. They need to take risk profiles into account, and so on. And then it's a table. And it literally is a very lengthy table of restrictions on how much you can invest in different sized companies, how much you can invest in different credit rated debt instruments, on how much you can invest in hedge funds, how much you can invest in private equity, and obviously the overarching big requirement, 75% limit on investment in equities. Interestingly, Regulation 28 does not prescribe, nowhere will you find reference to 30%. That comes out in ex-con circulars. It's not embedded in Regulation 28. Now, this is the most important clause, this Regulation 28.4D, which requires that application of the look-through principle in the context of disclosure of foreign assets must be done in accordance with conditions set by the SARB, and that the look-through may not be used to undermine or conflict with the conditions set by the SARB. So SARB expressly determined in circular, as we now know, that these foreign ETFs, which clearly are made up of foreign assets, they're not confused about what these foreign ETFs are, should be treated as a domestic asset and not a foreign asset. And hence, it's not appropriate to use look-through principle of the regulation to now reclassify something that SARB has said is domestic back to being foreign. In fact, if you try to do that, you would be contravening Regulation 28 itself and the requirement that you cannot conflict with SARB when applying look-through. So I hope that kind of clarifies the issue of the look-through principle in Regulation 28. So where are we at the moment? At the moment, as it stands, exchange control circular is law. It applies and applied immediately on being issued. And hence all investors can regard foreign ETFs as domestic assets. So just as an example of a Reg 28 compliant portfolio, you could invest 10% in a BlackRock S&P 500 index tracker, that would be regarded as foreign equity, 20% in Coronation Global Equity Fund. By the way, this is not a recommendation, just an example. Unit trust, that would be regarded as foreign equity. 30% in Sygnia Itrix MSCI World Index Tracker, that would be regarded as domestic equity exposure. 15% invested in Sygnia's Fourth Industrial Revolution Index Tracker ETF, that would be regarded as domestic equity. And the 25%, because don't forget, you can only invest 75% offshore, say in a Coronation Bond Fund, that would be a domestic bond. So you can suddenly see how much more freedom you have in structuring investments. Now let's look at FSCA and what FSCA is likely to do going forward. So FSCA undoubtedly was caught by surprise. I don't think that they were consulted in this process. I think that this process happened at SARB and National Treasury. We have reached out to the Reserve Bank. They have confirmed the circular as it stands. But undoubtedly FSCA is caught by surprise. But let's look at FSCA. What is FSCA? Well, FSCA is a market conduct regulator. And by their own mission statement or vision on their website, the aim is to enhance and support the efficiency and integrity of financial markets and protect financial customers by promoting their fair treatment by financial institutions. So incidentally, that's an important statement. Right now, if you have list platforms, financial institutions, which are blocking or prejudicing your ability to exercise your legal rights to invest in whatever you want to invest in, provided it's in line with Regulation 28 and the law, you can actually complain to FSCA. FSCA is also there to provide financial customers with financial education. And FSCA assists in maintaining financial stability. They don't ensure they assist. As I've already said, FSCA can prescribe more restrictive rules relating to foreign investments than SARB. So if SARB said 30%, theoretically, never done it, FSCA could come in and say for institutional investors, it's going to be 20%. But what it cannot do is it cannot unring the bell. So now that SARB has classified domestic ETFs into foreign ETFs, FSCA can't come along and reclassify them back to being foreign ETFs. What it could do is it could prescribe new specific limits on inward listed ETFs. So what it could do in terms of Regulation 28, it could introduce an additional category referencing inward listed ETFs and say you are restricted to, say, 10% investment, which, in those kind of instruments. But there are a couple of points on that. If they did that, that is tantamount to overriding SARB on the issue of foreign exchange controls, which they've never done before. If they did that, they couldn't really limit themselves to just inward listed ETFs, because the ExCon circular didn't just reclassify ETFs. It also reclassified bonds, exchange traded notes, derivatives, so everything that's inward listed. So if FSCA started reclassifying, or at least, limiting inward listed ETFs, it would have to do exactly the same to inward listed equities, bonds, ETNs, derivative instruments. So all the instruments that SARB has just reclassified as being domestic, where SARB has just said institutional investors can invest in these instruments with no restriction, FSCA would have to come in and say, not so, no, we disagree with the Reserve Bank of South Africa. And the only way that they could do that is by amending Regulation 28. And this is not a note. This is again, comes from the legal opinion. It is a substantive amendment of instrument category limits. And it would have to be put out to public comment, like any change of any regulation. And of course, in putting out for public comment, FSCA would have to justify that it's in the best interest of investors. And I think that would be very difficult to argue. And it would have to argue that it is for the purposes of assisting in maintaining financial stability. Again, it's a very difficult argument to put forward. I'll explain why just now. And of course, the moment it's open for public comment, we would comment, and so would others. And I suspect many people would weigh in on this debate. And besides that, let's be perfectly frank, FSCA has plenty of tools at its disposal. There is the information circular PF 130 that most retirement funds are well familiar with, which requires pension funds to have investment policy statements, which set out the objectives, the mandates, the strategy that the fund would follow, given the nature of the liabilities of the fund. That ties in with the qualitative aspects of Regulation 28, where once again, boards of trustees have a fiduciary responsibility to take the liabilities of each pension fund into account when setting the investment strategy, which basically means, it is unlikely that any retirement fund in South Africa today will take 100% of their assets offshore. And then, of course, you have supervision of FSPs. So once again, FSCA supervises the advice provided by individual FSPs. And hence, again, they can weigh in if they believe that that advice is irresponsible or doesn't take into account the risk profile of the member or doesn't take into account responsible investing. So, the FSCA has plenty of tools to ensure that this change does not prejudice customers and consumers and that portfolios remain well diversified. It actually doesn't have to do anything. So what is the likelihood of FSCA overruling SARB, which it has never done before? Well, look, the circular itself is very specific in its intention. So it provides that, and I'm quoting, inward listings attract foreign direct investment to the domestic economy, grow market capitalization and liquidity of South African capital markets, support the new Partnership for Africa's Development Initiative, and support, important, enhancement of foreign investment diversification through domestic channels. Support enhancement of foreign investment diversification by using domestic instruments. So that is the objective. And this is what FSCA would have to argue against. Then another nuance. Regulation 28 itself actually falls under the auspices of the Minister of Finance in terms of the Pension Funds Act, which authorizes the Minister of Finance, the same Tito Mboweni who stood up and issued the ex-con and talked about the relaxation of foreign exchange controls. He is actually the person that would have to sign off on the new Regulation 28. And then FSCA's own strategic document on their website states that FSCA must deliver and support government policy objectives for the financial sector. FSCA takes its policy direction from the National Treasury, whose objectives are in turn informed by the broader government strategic and development plans. The FSCA's strategic priorities are guided largely by the commitments expressed by the National Treasury in its policy statements. So given that FSCA is there to support National Treasury and support institutions such as SARB through its actions, not override them, what are the chances? What I do see happening is, however, over the short term, and is that individual retirement annuity funds, so basically your LISP platforms through which you have your retirement annuity or your preservation fund and LISPs, may block access to inward listed ETFs simply because it's a huge threat to their own book. Most LISPs, most retirement annuity funds are provided by active asset managers who cannot issue these ETFs. I mean, they cannot launch passive funds, that would go against everything that they believe in. This legislation directly threatens the assets under management, particularly in the domestic category initially, but it also exposes their own investors to investing offshore in a passive, cheap manner. So over time, it threatens not only the domestic assets, it also threatens the very highly, most profitable segment of their book, which is the international products. So I expect that individual retirement annuity funds, preservation funds, LISPs will try to block access. However, the boards of trustees have a fiduciary duty to act in the best interest of investors. So what you might know is that your retirement annuity, there's actually a board of trustees which governs the overall retirement annuity fund, which provides you with an access to individual retirement annuity. So those boards of trustees have to act very carefully if blockages to be applied. And if they do block such access, you can simply move your RA or a preservation fund to another provider. And by the way, you can also complain to FSCA. And as far as Sygnia is concerned, we are open for business. You can invest 100% of your RA offshore should you wish to do so. Now, in arguing that this relaxation is not in the best interests of South African investors, I think most asset managers, which I'm quite sure will form a lobby group around this, most providers would actually have to justify what they're saying in the context of what has happened in South Africa in the last 10 years. And this is what I'm finding quite terrifying. And why Regulation 28, as it stands at the moment, or more important, not Regulation 28, but foreign exchange controls, have not served South African savers well. So if you look at the last 10 years, just the last 10 years, and if you look at the returns that the JSE, All-Share Index or the SWIX Index, doesn't matter, have delivered per annum, it's been 8.7% roughly. The MSCI World Index, broad diversified world equity basket of equities, has delivered 10% per annum more. So if I compound it, 10% per annum, that's not a small number. In fact, if you had invested in the MSCI World Index, now a domestic asset, domestic equity, your domestic exposure would have grown by 433% instead of by 130% over 10 years. So we're talking about 3 times the level of return that you have gotten from domestic equities. Most scarily, if you translate the domestic equity exposure into dollars with the rand depreciation, the All-Share Index has delivered 0 return in US dollars to South African savers over the last decade. 0, nothing. So, you basically have gone backwards. If you factor in inflation, you have gone backwards. At the same time, if you had been invested in an MSCI World Index or S&P 500, you would have had positive inflation-beating returns. And then if you want to take a look at how that translates into rand cent amounts, if you had invested 10 years ago 100,000 rand in South African equities, All-Share Index, that money would have grown to 229,000 rand. Invested in MSCI World Index, such as now classified as, if it takes the form of an ETF as a domestic instrument, it would have been almost double, 532,000 rand. If you had invested $100,000 in South African equities over the past 10 years, you actually would have landed up with less than what you invested in. If you had invested it in the MSCI World Index, you would have more than doubled your money. So I think it will be very difficult for FSCA and anybody else to argue that in trying to go backwards and override SARB, you are acting in the best interest of South African investors, which is why I think any changes to Regulation 28 would be very difficult to get past the public comment bit. And of course, that would also be open to court challenges. But I actually think that this development doesn't come against, a vacuum. I think it's a massively positive development for South African savers. So as I've shown you, the returns from South African equities have been beyond pedestrian, to the detriment of all investors as well as the economy, because low real returns mean that people retire poor, they spend less, they consume less, they can afford less. And remember that consumer behavior and consumer spending drives economic growth. At the same time, the JSE has shrunk, so the number of opportunities on the JSE has declined. And many of those shares out of the 341 that's left, vast majority are completely uninvestable. They're small caps. They are so illiquid that you can't really include them in institutional portfolio, which basically means that opportunities to invest in what should constitute your growth asset in your portfolio are extremely limited. At the same time, Naspers and its proxy process on the back of Tencent exposure now constitute 21% of the market capitalization of the JSE. So almost a quarter of the JSE consists of a single Chinese share. That's your great diversification opportunity. Development encourages savers to invest in passive low-cost strategies. Again, very difficult thing to argue against. Higher returns that you can potentially achieve by diversifying your portfolio more offshore would be a boost to economy, because savers feel richer, spend more, pay more taxes, are more inclined to retain their savings in South Africa. as opposed to slowly bleeding everything offshore, and just feel more confident that they will be able to retire in comfort. And what most importantly in all of this is that let's look at who this affects the most. This doesn't affect the wealthy, and it doesn't affect those who already have big pots of money. Big pots of money sit with people who are over the age of 55, who have already accumulated the money that they want to accumulate for retirement. Well, hopefully, I know that everyone retires with less than they should, but just work with me here. People with big pots of money are the older people, not the younger people. And those people, provided you're over the age of 55, have the option of converting their retirement annuities to living annuities and investing that money 100% offshore if they wish to, which incidentally none do, because if you're living in South Africa, you need income in South Africa, and South African bonds offer very attractive yields at the moment. So this regulation isn't targeting people in living annuities. It isn't targeting people who have accumulated big pots of assets. It actually works for the younger savers and for low and middle income groups that are still saving for retirement. So this isn't the biggest, this regulation really isn't impacting the big pots of money, which is kind of the post-retirement money. It's impacting the smaller pot of money, the money that is being saved for retirement. And so, if you look at that, I truly believe that anyone who's not embracing this is not acting in the best interests of the customers or the investors. And, I actually couldn't believe what happened last week in South Africa. Instead of people celebrating, instead of service providers, and I do know and appreciate it hits some people's bottom lines, but instead of people celebrating this, there was one naysayer after another coming on the radio, going on Twitter, saying, not so quick, don't do. Seriously? It was absolutely, as far as I'm concerned, absolutely appalling display of greed over investors' interests. Now for South Africa, why is this positive for South Africa? Why would the Reserve Bank or National Treasury do this? And I think that there are some very good reasons for why this has been done. One is that it encourages money and people to stay in South Africa instead of emigrating. So if I know that I can invest my savings offshore with no limits and I'm safe in that knowledge, so I'm not exposed to volatility of the JSE or the lack of diversification of the JSE or for that matter, the depreciation of the currency, then you know what, I'll think twice about, I would much rather be based in sunny Cape Town than rainy London, trust me, personal knowledge. It encourages, as I mentioned, financial immigrants and non-residents to keep their wealth in South Africa, especially their retirement annuities, which everyone is financially emigrating to in order to move their retirement annuities in order to invest offshore. Well, you no longer have to financially emigrate. You can now take your retirement annuity, invest most of it offshore, if not all. As I mentioned, I don't think we will see a flood of money moving offshore. So professional boards of trustees still must take the liabilities of the retirement fund into account when designing sensible investment strategies in line with PF 130. So that is not going to be 100% offshore exposure. Only 75% of assets can be invested in equities anyway, and international bond markets are hardly an attractive proposition with negative interest rates. South African bond markets are very attractive in the world of negative interest rates, and particularly for retired people where income matters, they will still tend to overweight their portfolios towards high-yielding South African bonds. Now, the big fear, weakening rand. Well, actually, to be perfectly frank, the rand is too strong. We need a weaker rand. A weaker rand would help to devalue South African debt levels by stoking inflation. It would make exports more competitive. It would attract tourism because it would be a cheaper destination. It would make infrastructure investment more cost effective. So right now, from a macroeconomic perspective, we want a weak rand. I was actually quite disappointed. I know it's perverse. And maybe because I've already moved my retirement annuity mostly offshore a week ago. But right now, South Africa needs a weak rand. It doesn't need a strong rand. Strong rand is working against us. So if this legislation means that there's some flow of money, which incidentally, unfortunately, I don't think it will achieve it, but a weak rand would work for us. But unfortunately, this weakening this relaxation comes against the background of global negative bond yields and these enormous amounts of money again flowing into emerging markets, and in particular into emerging market debt. And so any rand effect of the outflows will be cancelled out by the effect of the inflows coming into South Africa. And finally, we need foreign investments and foreign listings. And there's another circular that SARB has issued following this circular, which now allows for instruments in foreign currency to be listed on the JSE as well. So this circular is part of a well thought through strategy. It's not just a random event with unintended consequences. I would argue that from everything I have seen, this is a very intentional strategy. So, it would be a miss of me not to tell you what, now that the world of investments is open to me, what would I do with my money? Because all of a sudden I can invest in sectors I could never touch before with the bulk of my savings. I certainly would avoid the sectors that have been and will continue to be impacted by COVID. So tourism, sports industry, entertainment industry, any kind of mass events, retail marketplace. I think that potentially has been invariably and permanently changed by online shopping and moved to online shopping. Fintechs and banks, I think, wait for the credit rating downgrades of banks on the back of sovereign credit rating downgrades, and commercial real estate, because I think the working from home trend will continue for a very long time. But what sectors would I look at? Healthcare industry, absolutely race for the vaccine. Great news this morning for all of Sygnia investors, well, at least from feel-good perspective. Most of you, through Sygnia products, have a small exposure to the Oxford vaccine produced by AstraZeneca, or manufactured by AstraZeneca, but the actual IP vaccine is owned by one of the companies which sits in Oxford Sciences Innovation company. And as you know, we've been marketing a product which invests in OSI, which in turn invests in Vasitex. So yay for South African investors invested in the Oxford vaccine. But we do believe that healthcare is one of the mega trends, and Iva will talk to that a lot more just now. Online retail industry, anything online, Amazon, delivery services, couriers, online entertainment industry from gaming to betting to Netflix, virtual communication tools, Zoom, cloud computing, and microlending, because I think, access to capital will be more difficult. A few more slides from me before I hand over to Iva. Why Sygnia Itrix ETFs? Well, Sygnia has one of the longest performance track records of any passive manager in South Africa. In fact, I've always been a believer. I managed my first index tracking fund when I was 25, working for Southern Life, believe it or not. But Sygnia itself has a 17-year performance track record in managing passive funds. We are also the innovators in the space. We were the first to launch a fully replicated equity indices, the first bond index tracking fund, the first listed property index tracking fund, the first risk profile, the global balanced funds, or skeleton funds, balanced international passive funds, a technology-focused passive fund for the Industrial Revolution, FANG fund. We are the largest provider of index tracking ETFs listed on the JSE, excluding commodity funds like gold and platinum, and the largest provider of international index tracking ETFs referencing foreign assets listed on the JSE, with a 13-year performance track record and almost 24 billion in assets under management. In terms of Sygnia Itrix, I've mentioned to you before the role of the buyer and seller of last resort. Our ETFs are backed by Jane Street, the largest company you've never heard of. They are one of the world's largest market makers. They trade over $21 billion on a daily basis in global equities, bonds, and ETFs around the world. A little bit of patriotic side. We in Sygnia Itrix ETFs do not use feeder funds with an extra layer of cost. We manage all our ETFs in South Africa using South Africans. We pay taxes on our management fees in South Africa, so they accrue to South African fiscus. We develop skills in South Africa, and we contribute to job creation in South Africa. So every single one of our competitors in the space, and there are only a couple, use feeder funds. So they basically don't manage the money themselves. Yeah, someone else benefits. We manage everything in South Africa in a very proudly South African manner. We also administer our own ETFs and trade seamlessly in underlying shares, which means we've got very narrow tracking errors. So the difference between the returns of our ETF and the return of the index is minimal. And we offer the practical ETFs for core exposure, like MSCI World Index or S&P 500, and highly innovative products for thematic exposure. And most importantly, our passive investing makes sense. Low management fees, so S&P 500 index, our ETF, is priced at 0.15% per annum. Compare that to possibly the 1.2 or 1.5% that you're currently paying one of your active asset manager providers. Top performance, I'll show you just now. Wide range of themes and options, efficient and immediate implementation, and top investors worldwide are opting for passive. And as I always say, you don't want to go against the herd. And then again, passive management has won the performance debate. So you are not compromising on performance here. And you don't have to take my word for it. I always make reference to S&P survey, which is published on their website. And what they do is they look at general equity unit trusts and the percentage of general equity unit trusts, actively managed general equity unit trusts, which have underperformed the relevant market indices in their relevant geographies. And they do it on a rolling 5 years, 3 year and 1 year basis. So in United States, over 5 years, the chart refers to 5 years, 71% is 3 years and 63% is 1 year. So over the past 5 years, almost 78% of actively managed general equity unit trusts have underperformed S&P 500 index. In South Africa, 94% of actively managed unit trusts have underperformed the top 50 index. The same in Australia, 79.9%, Canada, 97%, Europe, 72%. So again, my famous saying is, you know, if I invited you to my casino and offered you 80-20 odds of losing, would you play? And then just looking at Morningstar survey of international global equity funds. So again, are you compromising in terms of returns? Well, if you look on a 1 year, 3 year and 5 year basis, Sygnia Fourth Industrial Revolution funds and the FANG funds, technology-based funds, are obviously right at the top. So I'm not even going to refer to it, but you have on a 1 year basis, 71 different unit trusts in the global equity category. So this is after all fees are taken into account. And the Sygnia Itrix S&P 5, so yes, you've got all these tech funds which have delivered spectacular returns, but ignoring that, just look at S&P 500. It's ranked 21 out of 71 funds, ahead of 91, Ellen Gray's, Old Mutuals, Coronations, Prudentials, you know, all the big brand names. On a 3 year basis, 7th out of 54 unit trusts in its category. Again, just a generic S&P 500 ETF, now regarded as a domestic investment and priced at 0.15% per annum. And over 5 years, it's right at the top. And then my last final slide before I hand over. Don't stand against the herd. You know, the money has moved from active mandates to passive mandates in huge volumes in the US and in Europe. And these are just some of the headlines from the Financial Times that I've pulled in the last few months. And you know what? I haven't found a headline yet which says money is moving from passive investments to active. In fact, every single headline talks to investors fleeing active funds to passive funds. Absolutely every single one. World's biggest pension fund steps up passive investing. MSCI, passive investing will be good for society. price, yes, active investment funds perform worse, study funds, and so on and so on. And again, there are a lot of headlines right now about the fact that through this crisis, actively managed portfolios have once again underperformed market indices. And that brings me to the end of my presentation. And let me hand you over to Iva, who will take you through some of the funds that we have that are on offer that now are classified as domestic, as well as a few that we are launching in February, which might be of interest to you if you are designing a well-diversified portfolio. Thank you very much.
Okay. Good morning or good afternoon rather to everybody, and thank you for joining us this morning. Thank you, Magda, for covering all of the legalities around the new regulations. So what I want to take you through is our offering in terms of offshore ETFs. Now, Sygnia is the largest provider of international ETFs being traded on the JSE. So if you look at our current offering, we have 6 regional global equity funds, as well as 2 specialist funds. And from a performance perspective, as you saw in some of the previous slides, these offshore indices really have provided South African investors and South African retirement fund portfolios. The offshore portion of portfolios is really what has helped performance over the last year. But the true star in terms of performance has been the Sygnia Fourth Industrial Revolution Global Equity Fund. Now, this Fourth Industrial Revolution Global Equity Fund is available as both a unit trust and an ETF, and it tracks the S&P Kensho New Economies indices. So if you had to invest in this fund, you would have access to companies that are at the forefront of driving the Fourth Industrial Revolution. So it's all technologies that have all these new technologies such as clean tech, drones, 3D printing, artificial intelligence, and these are really the technologies that are driving the future. So looking back to the year 2005, that doesn't seem that long ago, if we had to look at what were the most valuable companies in the world back then, well, it was typically financial services firms, big conglomerates, companies involved in oil and energy, and in fact, only Microsoft was was a tech company that at that stage was one of the most valuable in the world. Fast forward to today in 2020, and we have the 5 largest, most valuable companies in the world being all tech firms. So the idea with investing in the Fourth Industrial Revolution Fund really has to do with finding the opportunities for growth and where the new revolutions are coming from. So it's all of these smaller companies that we might not be familiar with today, that hopefully by the year 2030 or 2035, if we had to look at a chart such as these, we would hopefully have some of the companies in the Fourth Industrial Revolution Fund being the largest and most valuable in the world. So Kensho, they track 22 separate subsector indices. So if you look at, for example, the space index, there's a whole lot of companies in the space index, all involved with new technologies around space exploration. Likewise, in the drones index, a lot of companies involved in drone technologies. So there's 22 separate subsectors, and we invest in the composite. So you would have access to all of these technologies. And just by way of an example, if we had to look at the 3D printing is its own index, and companies in the 3D printing index are involved in the 3D printing technologies. And these could be anything from being able to 3D print human tissue to being able to 3D print clothing that controls temperature and controls body heat and doesn't wrinkle. So that's just an example of the one index and what companies are involved in that specific subsector index. Likewise, if you had to look at autonomous vehicles, it's an index full of stocks involved in all of these technologies. So there's some companies that are involved in the connected services, some just in the software, and some such as Tesla. I mean, they actually do have autonomous vehicles and electric cars such as the Tesla that we're all very familiar with. So as much as some of the companies are much smaller, it is a very well diversified fund. So if you had to invest in the unit trust or the ETF, you would have exposure to over 380 companies. But From a weighting perspective, none of these companies really hold a huge weight. This is not a market cap weighted index. Kensho does the weighting of the actual individual constituents differently. They use algorithms, artificial technology, and different metrics in order to weight the companies. So from a weighting perspective, what I'm showing you over here are the top 10 holdings, and you'll see that even the top holding at the moment in this fund is only at 2.7%. And what you'll also see, which has really driven that phenomenal performance that we have seen of this fund over the last year, you'll see that some of these stocks have returned some phenomenal returns over the last year. So we really do believe that exposure to this fund is important. It is driving the fourth industrial revolution, and it will most likely continue to do really, really well over the near future. And then I just wanted to give you some insight into some of the ETFs that we launched in early 2021. So these will be launched in February of 2021. We will hold a separate webinar where we will unpack more details around each one of these 3 ETFs, but I wanted to give you a high-level overview of what you can expect. So the first one is an ESG ETF. Now, let me start off by what is ESG. E stands for environmental, S stands for social, G stands for governance. And these characteristics are becoming increasingly important to both institutional and retail investors. So this ETF will track the S&P Global 1200 ESG index. So it's a very well diversified, broad market global index. And the companies that are excluded from this ESG index are companies, for example, that would be involved in the development of or manufacture of controversial weapons, or companies that generate electricity from thermal coal, companies involved in the tobacco industry. So any company with a very low ESG score would be excluded, and it makes it an attractive investment from an ESG perspective. Now, with institutional investors, for example, retirement funds in South Africa, retirement funds have to now include in their investment policy statements exactly what they're doing from an ESG perspective. So how are they selecting the asset managers and ultimately the companies that they're investing, and how they're taking into account the ESG characteristics of these companies. So it's very, very important for institutional investors to have this ESG focus, but likewise for retail investors. There's many studies that show that the growth in the proportion of retail investors being focused and investing in ESG type of investments and indices has been growing, and it is set to continue to grow. And millennials in specific are very interested in not only earning a return from the investments, but also investing in assets that align with their core values and their personal values, and these assets that are able to contribute to the broader social good of the industry and the world. So we do believe that this ETF is very well placed to meet the needs of both institutional and retail investors. And just from a top 10 holdings point of view, what can you expect in terms of the companies that you will have exposure to? A lot of these are household names. They've done phenomenally well, and a lot of the tech stocks are included in this index that we will be tracking. Then we're very excited to launch an emerging markets ETF. So this specific emerging markets ETF will track the MSCI Emerging Markets 50 Index. Now, these are the 50 largest and most liquid stocks that come out of the emerging markets. And if you had to look at these 50 stocks and which regions they really represent, about 50% of the exposure will be China, and about 80% of the exposure will be Asian economies. Why that is important is these are really the economies that are driving global growth. If you look at the chart that I have on the left-hand side, this is sourced from World Bank and IMF data. They predict that by 2024, which is only a few years away from today, 4 of the 5 largest economies in the world will be Asian economies. So it's really important to have exposure to this region of the world. And this growth is really driven by the growing middle class. So if you focus on the little pictures that I have included on the right-hand side, you will see that at the moment, 54% of the middle class around the world comes from the Asia Pacific region, but in the next decade, that is set to increase to 65%. So it really is an important region and an important area of the world to focus on from a growth perspective. There's also been a lot of great innovations from a tech perspective that have also come from those regions. So if you think of companies such as Tencent, Alibaba, those are all coming out of emerging market economies, and our very own Naspers that also forms part of the top 10 holdings. So these are the kind of stocks that you can expect to have exposure to should you choose to invest in this emerging markets 50 ETF. And from a performance perspective, you can see the gray line represents this index that we will be tracking, and the orange line is the broader emerging markets index. And you can see, especially over the last 5 years, this growth in the middle class, this innovation when it comes to technology, you can see the performance differential between the two indices. And lastly, very exciting, we are launching a healthcare ETF. So this healthcare ETF will give you exposure to 150 of the largest, most liquid global healthcare stocks. Now, some of you may be aware that we launched our healthcare unit trust in August. After launching that healthcare unit trust, we had a lot of demand from our clients to also launch a similar instrument as an ETF. So based on that demand, we then decided to launch this healthcare 150 ETF. Now, thinking about healthcare is very topical at the moment. Of course, we do find ourselves in a pandemic. So a lot of the news articles that we read are about hospitals, about development of treatments and vaccines. But just looking at the market cap of the 5 largest pharmaceutical companies in the world, they outstrip the size of the JSE. So that's just to give you an idea of how huge this sector of the market really is. And from a profitability perspective, the profitability of these companies is anywhere between 5 and 95%. The aging demographics, in addition to the fact that we find ourselves in a pandemic, and experts have said that we can expect these pandemics to happen a lot more frequently going forward than has been in the past. So we might not wait another 100 years before we find ourselves in another pandemic. But that, together with the aging populations around the globe, really is driving this focus towards healthcare. And looking at the spend by governments, the United States in 2018, spending 17% of their GDP on healthcare spends, and this is only set to increase going forward. It's definitely a sector that cannot be ignored. There's also a lot of innovation in the healthcare space. Again, as I mentioned when I spoke about the Fourth Industrial Revolution Fund, there's 3D printing of organs and human tissues. There's making use of virtual reality to simulate training environments, using artificial intelligence to assist with diagnostics. There's so much innovation happening in the healthcare space. And from a performance perspective, you can see that the healthcare index over the last decades has really outperformed the broader MSCI World Developed Market Index, and that is set to continue in the future. So we really feel that healthcare is definitely a sector of the market that investors really need to have exposure to. The sector is very limited in South Africa. There's a couple of stocks listed on the JSE, but mostly hospital groups. Government focus has never been greater. Of course, it's very topical right now, but as I said, this is set to continue into the future. There's a lot of research and development in the space, and of course, performance has been phenomenal. And in terms of what you can expect, in terms of top 10 holdings, very well-known names, the likes of Johnson & Johnson, Roche, Pfizer. And what's quite exciting is so many of these companies are also involved in the vaccine development. In fact, I looked at the 150 holdings that we will track in this ETF, and 9 of them are at very, very advanced stages of being involved in providing vaccines for COVID-19. So Moderna, for example, it might not be part of the top 10 holdings, but it is one of the 150 stocks that we will be tracking. And lastly, as Magda mentioned, passive investing cannot be ignored. It's very fast growing both locally and globally, and that's the growth of just normal index tracking solutions as well as ETFs. And this shows us the growth of AUM just for Sygnia's assets under management in passive solutions. So it's low cost. It gives investors access to phenomenal exposures outside of South Africa as well. And we do believe that this trend is set to continue and that ETFs really are the future. So thank you very much. As I said, we will host a more detailed webinar where we will really unpack these 3 new ETFs as well as our broader ETF offering to give you some more details. And now I will hand over back to Magda and she will answer some of your questions. Thank you.
Hi, so I can see that there are a lot of questions. I'll try and answer as many as I can, and then I'll just watch the drop-off rate. And as people get bored, I'll stop answering the questions. Can I comment on FSCA Communication 53 stating that FSCA will be providing guidance, no presumption pertaining to financial sector conduct laws should be formed? First of all, there's no such thing as financial sector conduct laws. Neither is there such a thing as presumption. When it comes to law, there is just a law. So yes, as I mentioned before, I do believe that FSCA was caught by surprise and needs time to kind of digest what it means and whether it wants to in any way wade in on this debate and what form that wading in could take. And really the only way, based on the legal opinion, is for them to amend Regulation 28, as I mentioned, which would be quite a lengthy process. But given the amount of inquiries that they were facing, I think they had no choice but to put something out. And really it was a very weak, I don't want to say poor communication, because it left more questions on the table than answers. But just to be clear, there is no such thing as presumption. There is just the law, and we are following the law, and so can anybody else. If they want to amend the law, they must do so. Is Sygnia already increasing the ETF exposure regarding the previously offshore ETFs into the equity component, or waiting for further information from FSCA? So Sygnia's investment team, obviously managing our skeleton funds, our signature funds, follows their own views and their own best house view. And they will act depending on what they believe will generate the best returns for investors at any given point in time. Look, I think realistically, and this is an interesting kind of psychological fact for all active managers, multi-managers. South African asset managers have not been used to freedom as far as offshore investing is concerned. They have all operated within the same constraint, and for a number of years now, it's been 30%. So suddenly to be offered complete freedom, that's a big psychological move. And I think it will take everyone, or asset managers in particular, because it's not specific to Sygnia, a little bit of time to wrap their minds around how much offshore exposure they want to have in their portfolios. And I believe it will vary over time. But if I was a guessing person, I would say that given the domestic nature of the liabilities in most pension fund portfolios, we will see most asset managers settling on offshore exposure of around 50% in time. But really, it's up to our investment team, depending on what they're seeing in the markets right now and where they see the opportunities lying. But yes, if they wish to, they can increase their exposure over 30%. So there are a couple of questions under the same banner, whether we will be increasing our offshore allocation in skeleton funds, for instance, to higher equity exposure. What we are doing, because there's such thing as a best house view that an investment team puts forward, but there's also a demand from investors who just want higher offshore exposure. So what we are designing right now is we are designing a global balanced product range, which will have by its nature a much higher offshore allocation. And so investors can choose between kind of Sygnia's investment team's best house view or make a decision themselves because they want to have, it won't be 100% offshore, but it will be naturally at all times permanently higher offshore exposure. There's a question of, does Regulation 28 not refer to underlying assets? Again, it's the look-through principle. I think I've dealt with that a number of times. Regulation 28 refers to underlying assets through the look-through principle, and in particular prohibits using that look-through principle to underlying assets as a manner of or method for overriding what the Reserve Bank says. And the Reserve Bank says that the ETF is a domestic instrument. Thank you for the information. But can we now invest in these ETFs with our existing retirement annuities with Sygnia? Yes, you can. I think I've mentioned we are allowing it. Which industry players will be opposing this, and why would they? I think that, active asset managers will have to wrap their minds around this. It's a threat and an opportunity. Opportunity from a perspective that they can also invest in these instruments. They are also on the list, and they could use these instruments as tools within their global balanced portfolios. But at the same, they could see it as an opportunity, but on the other hand, they can see it as a threat. And that is because, they're not able to launch these kind of products. They cannot launch passive funds, where the whole premise of their business proposition to you as an investor is that they can outperform passive index tracking funds, even if they don't necessarily do so. So I think that there will be a lot of resistance from active asset management industry, simply because it threatens the domestic assets, which could suddenly be withdrawn from them and flow into these ETFs, and potentially threatens their very expensive offshore assets over time. So I do see a lot of doomsday, and I've already seen a couple of notes put out by the large asset managers saying, stop, don't do anything, etc. All signed by head of retail distribution, incidentally, none by the legal departments. Would you give an example of 100% offshore using the new changes? I think I did in the presentation itself. I think a number of these questions came in before the presentation. What if there's enough pressure placed on FSCA from the unit trust fund managers to not agree with SARB? We'll go to court. I'm willing to, as Sygnia right now, say we will go to court. And I want, I do believe that what has happened is in the best interests of South African investors. I don't believe that FSCA will not support SARB. I don't believe that it's in the mandate. I don't believe that that is what they are all about. They are about ensuring responsible conduct by market providers. They are about monitoring, supervising regulation, but they're not in it for taking positions on issues of monetary policy, on national policy. They are there to support the SARB. They are there to support National Treasury. But if we believe that there is enough, and again, yes, organizations like ASISA largely represent interests of active asset managers, and potentially there will be lobbying. But FSCA in the past has not shown itself to be that open to lobbying either. So I do believe that it caught them by surprise, which probably wasn't the best thing. I think they should have been involved in those discussions, or had at least sight of what was coming. But I think, when the discussions have happened, they will either do nothing, or they'll put out a clarifying memo. But if necessary, should they propose changes to the regulation, and if we believe that, in order to limit investments in low-cost, passive, international products, so let us be clear what this regulation would be doing. It would be restricting South African savers from exercising their right to earn decent returns. We are more than happy to challenge it and take it on appeal. Not on appeal, sorry, to change it, to challenge it through whatever methods are available to us. When will the switches work? As Regulation 28 on the system blocks the switch. I think we just need to, software developers are very busy reprogramming the system to unblock the Regulation 28. Please email Sygnia Lisp. So it's, I think you'll find the email address on our website. I think it's sfs@retail.sygnia.co.za if you want to effect changes. It will take us a couple of days to amend, to make the software changes on a platform to ensure that the Regulation 28 blocker doesn't block your switches. Are all foreign ETFs now legal to buy? All the ones that are classified as inward listed. So there's a process for listing these ETFs. Sygnia was in fact a little bit by luck with the first providers of inward listed ETFs referencing foreign assets. So each product that we listed had to go through SARB approval. You know, I'm not sure if every single one of the foreign ETFs has the same, you know, is considered to be inward listed. It depends on what process they followed in getting the ETF approved. So I think you need to check with the provider. Look, there are only 4 providers, and there are 2 large providers of these ETFs, Sygnia and Itrix, and there are 2 small providers, Cautious and One Something, which is I think One Invest, which is Stanlib. They very short track records, very few products. So I would just check with the ETF provider whether their ETFs classify, but certainly all of our ETFs, Sygnia Itrix ETFs, qualify as inward listed ETFs referencing foreign assets. Can you name the attorney? I will name the legal firm, and that's ENS. They happen to have a very well-established pension practice and a very well-experienced lawyer. I don't want to refer to the particular lawyer who issued the opinion. You know, it's a very lengthy document. We've scrutinized the document. Our legal division has scrutinized the document. We've tested it. We've tested it against other ExCon circulars, against Regulation 28, and there's absolutely no reason to believe that what is in that legal opinion is incorrect. So again, will Sygnia balanced funds? I think I've answered the question, and I think, you know, the investment team will do what it will do, but we will also launch a product range where you can opt to have higher exposure. Where can you get the current wording of Regulation 28? FSCA website, Pension Funds Act. It's Regulation 28 as part of the Pension Funds Act. So, you know, I know that I've simplified because there's a question here around the precise wording of Section 28 4D, which has different wording, notwithstanding B and C. So our legal opinion deals with all the notwithstandings and the B's and the C's and the D's, and effectively comes up with a conclusion, which is what I put on the slide. So often reading legal documents is confusing because there are a lot of circular references to previous clauses. But when you distill it all, what I've put in, you know, on the slide with reference to Regulation 28, section or paragraph 4D, comes directly from the legal opinion once everything has been distilled. The neverthelesses and the ignores this and otherwise that clause applies. It basically, there is a statement there which says that you cannot override SARB. So you cannot use the look-through principle to override SARB. So, you know, I think again in that clause, the wording in accordance with conditions set by SARB is the key piece of verbiage that the lawyers use in the legal opinion. The classification by SARB is in contradiction with current classification by Regulation 28. Well, not really. Current Regulation 28 doesn't classify exchange traded funds as anything. Does the FSCA not have obligation to support the current? There is no classification, as I've mentioned before. There is not even a reference to 30% limit. There is just a reference to foreign exchange limits as set as by the Reserve Bank or by as prescribed by FSCA. So, you know, the SARB does not contradict the Pension Funds Act at all. Did SARB make changes with unintended consequences? I don't believe so. If you read the actual ExCon directive, it is very, very specific. It says the following category, these inward listed ETFs referencing foreign assets are now to be classified as domestic instruments. the following categories of investors can invest in these instruments without restriction. And then it lists institutional investors, etc., trusts, partnerships, companies, non-residents, and immigrants. So I don't believe that ExCon circular leaves no room for interpretation. I don't believe it is a law of unintended consequences on first reading. That's what it would seem like. It is so particular, it is so specific. And I actually do believe that it reflects the macroeconomic policy that the regulators want to follow. So, can that circular be withdrawn? I've never seen an ExCon circular be withdrawn before. An ExCon circular would have been drafted between the Reserve Bank, and we have some incredibly clever people at the Reserve Bank, National Treasury, in consultation with National Treasury. Clearly, there was no consultation with FSCA. Is the FANG fund available as an ETF? Not at the moment, but we are looking at launching a FANG fund in that space shortly. We obviously are looking at a lot more funds than we were looking at before all of this happened a week ago. I have seen only one other company mention this momentous change. Do you think others will follow or still refuse to implement? I think they will delay and delay and delay for as long as possible. Because why does it work for anybody other than people who do provide these ETFs? Emerging markets ETF coming in February from us. Sygnia Itrix ETF, and so as I've mentioned, we've got two fourth industrial revolution funds, one in the form of a unit trust, straightforward unit trust, one in the form of an ETF. Just subtle differences in some of the underlying indices, but it's effectively the same product offered into different wrappers. The preservation funds fall into the same category as retirement annuity funds, retirement annuities and retirement funds, so you can invest more than 30% offshore. So again, there's a lot of questions around will we be changing our own funds, and that is, I think I've dealt with that. Do we currently have an ESG fund coming in February? I think Iva has dealt with that. By the way, there's a question about considering ETFs in resources, gold, platinum, a la APSA. Those ETFs are funny beasts. They are actually very complicated products where they don't track any particular index. They actually hold physical gold in storage. In vaults, and hence they're not as straightforward as inward listed ETFs tracking a particular index. So pure commodity ETFs probably don't fall under the definition of inward listed referencing foreign assets. But potentially there's scope for looking at ETFs, which, and here I'm not a fan, but if you do launch a feeder fund ETF, we might look at launching a feeder fund gold ETF. But there isn't, if you do want gold exposure in your portfolio, you can do so through APSA gold ETF. It might not qualify as domestic exposure though. Offshore ETFs at an expensive level. No, they're not. As I mentioned before, Sygnia Itrix S&P 500 is at 15 basis points, not 0.15. And all the ETFs have a sliding scale. So if you have significant, but at least sizable investments, then the fees go down to 0.4% level for most of our most expensive ETFs. So there are sliding scales in terms of management fees. So as I've mentioned, we already have a whole stable of ETFs. There's a question about when are we planning to release these ETFs. They are alive and well. Sygnia Itrix ETFs, 13-year track record, 23 billion in assets under management. Would it not be better to stagger the switch? The concept of staggering is also, and phasing in rather, has always been a very clever way of averaging out volatility. So I do believe that you shouldn't do anything knee-jerk. And again, I do believe that when looking at things like this, you do want to consult a financial advisor, simply because, you know, it's so easy to say, I'm moving all my money offshore, I'm out of here. And that is actually not necessarily the right answer. You know, right now, for instance, South African bonds are offering fantastic yields. You're not going to get anything like that from offshore investing. And your situation, you know, you live in South Africa, your liabilities are in South Africa, you might require income in South Africa, which will come from higher yield. So, you know, it's not necessarily the right answer to immediately go 100% offshore. In fact, it's the wrong answer. So the right answer is consult with a financial advisor, spend some money, sit down with someone with sense, go through your financial affairs, go through your entire portfolio, through your plans, through, you know, where you are in life, through the risk you want to carry, and then decide what is suitable for you. How do we access Sygnia ETFs offshore products inside an RA? You know, if it's a Sygnia RA, you just email us. There is no problem around it. As I've mentioned, other retirement annuities will probably resist this change for as long as they can. And here the weight of demand really is what will tip the balance. The moment IFAs will start either switching the RAs away from other providers to Sygnia or Cetrix, for that matter, if Cetrix allows this, or if you know, if enough IFAs start phoning other list platforms, I don't want to name competitors, and demand access to these ETFs, then the access will be made available. But you know, if it isn't made available, you can always switch your RA. So yes, sorry, we are revising that Regulation 28 calculator, but please email us in the meantime. So what would local pension funds do that have invested overseas via your rep pair? You know, if you are a pension fund which has invested in our best house view portfolio, Sygnia signatures or Sygnia skeleton funds, you do nothing. You wait for our investment team to make the investment decision, unless, you know, you feel very strongly that, you know, as a board of trustees, because you're talking about a retirement fund, as a board of trustees, that you want higher offshore exposure, and obviously that's up to each board of trustees, in which case we can implement it alongside the existing portfolio if what we have inside the portfolio is not enough for you. The new sub-exchange sounds like good news. Does it require rebalancing of one's portfolio? Again, please speak to your financial advisor. I think you're no longer limited by the 30% rule, in effect, provided that you gain that additional offshore exposure via the ETF route. So, you know, again, consult, spend the money, even if it's a once-off fee, design a proper investment strategy. You know, we as South Africans are not used to freedom. We are used to living in boxes which have been designed for us for a variety of reasons. So I think, you know, it's you know, it's important that you do so with a clear mind, not in a rush, with proper advice on the table. There's a question about very personal, which ETFs did I switch my RA to? Well, you know, I'll answer it, but you need to take into consideration my age, my risk profile, my, you know, which all guide my decision making. I haven't taken 100% of my RA offshore. I use a mix of a fourth industrial revolution and S&P 500 index tracker to gain global offshore exposure. And, you know, I'm holding a bit of gold, and I'm holding the balance in the Sygnia all bond fund in South African bonds. I have 25% allocation to South African bonds, just because the yield is so appealing. But if I go offshore, you know, I mean, there's MSCI World Index and there's S&P 500 Index, but I kind of tend to believe that and that's a personal belief that, you know, almost more money will be pumped into the equity markets, which doesn't really, you know, talk to the health of the US economy. It just talks to quantitative easing in the US, and hence, you know, I've pushed more money into the US exposure. You know, I also have investments to the extent permittable in the Sygnia Oxford Sciences Innovation Fund within my RA. So it's a merry mixture. But I do believe in diversification, and then I do believe in South African bonds. You know, I believe in high yields that we are support that component. When can I start moving my RA to these domestic classified ETFs? Right now. So as I said, absolutely. Many thanks, Magda. By when would you have 100% Reg 28 RA? So I think that talks to the fact that rather than you designing an RA, we design a product which is 100% offshore. And I think, you know, it's a tricky question, because we have to act responsibly, and we also have to act in the best interests of investors. And as I've just mentioned to you in the context of my own RA, I haven't moved 100% of my assets offshore. So I think designing a global balanced portfolio, which is 100% offshore, there probably would be demand. I am not convinced, and those are still discussions that we have to have within Sygnia. There's absolutely space for us having a high offshore exposure global balanced portfolio. I'm not sure it's responsible of us to have 100% offshore exposure global balanced portfolio. I think those kind of choices individuals must make together with their financial advisors. It's not necessarily what I think would be considered prudent. So I don't think we would want launch one portfolio which kind of maneuvers the pieces to make it 100% offshore but global balanced. Someone is encouraging me to become a Bitcoin believer. You know, I've lost my shirt. And at $18,000, that's when I lost my shirt last time. So I cry in pain. I bought at 18 and sold at 4. But perhaps. I'm looking at the space. We're looking at the space. Obviously, there's some regulatory changes in the crypto space coming, with greater supervision of cryptocurrency providers becoming FSPs. So we are certainly re-looking at the space. And a lot of my younger staff members, which is probably most of Sygnia, are strongly encouraging me to become a Bitcoin believer. I think this issue of ETFs versus unit trusts. So the unit trusts have not been reclassified, by the way, guys. So if you invest in the ETF, that's domestic exposure. If you invest Fourth Industrial Revolution ETF, domestic exposure. If you invest in Fourth Industrial Revolution unit trust, that is foreign exposure. So it's only the ETFs that have been reclassified. The Health Fund Unit Trust. The Health Fund Unit Trust is up and running. It has been launched in August, so you can invest in it. Remember, again, it's a unit trust. It doesn't rank as domestic exposure. When will the ETFs be available on SURF? So this is what we're looking at. We design, so SURF is our umbrella fund. So there's the best house view range, and we are busy designing the higher offshore exposure range, which also will be plugged underneath, and every board of trustees or ManCo board really will have the option of deciding whether they want to go with Sygnia's best house view, which might have higher or lower offshore exposure at given points in time, or with the standardized product range, which has a static higher offshore exposure. Is it better in offshore? Is it better to invest 100% offshore, or to still have some investments, money market bonds? Well, I've told you what I've done. So, but I'm not saying mimic what I do. I'm just saying everyone is different. I have instructed. Well, thank you for those of you who are saying you are busy moving to Sygnia as we speak. You know, how should an individual investor view emerging markets exposure with care. So I think this is where you rather invest in a global balanced portfolio and leave it up to professionals to decide how much to invest between developed markets and emerging markets. The ability to judge what is right in terms of emerging markets exposure is best left to people who spend 100% of the workday analyzing exactly that issue. It's very cyclical, and as an amateur investor, so I will now put myself into amateur investor category, I am automatically attracted to developed markets. My investment team, who are true professionals, will at points in time either hold emerging markets or developed markets. They are obviously spending a lot more time analyzing the cycles, the flows of money globally, the macro policies globally. So as a invest, hold, don't think about it investor, I tend to go with developed markets, but that doesn't necessarily mean that I beat a professional investment team at Sygnia. I don't. I just kind of, don't have time to think about it too much. Do you see a rush to register more inward listed ETFs by major players? Not so simple. So you have to first register a unit trust company. It's a very specific unit trust company. It's not your standard unit trust company. So Sygnia actually owns 2 unit trust companies, one which offers these inward listed ETFs and one which offers a standard unit trust. So first you would have to register a unit trust company, and then you have to apply for each individual ETF listing. So it's at least a year-long process for other players to list or be in a position to list these ETFs. And the other problem, of course, is that who are those other players? As it's expensive to launch a ManCo. FSCA doesn't approve ManCos or management companies or collective investment schemes companies that easily. So you have to be a credible entity from financial soundness perspective. And then the problem I think most active asset managers will have, that fundamentally these ETFs are passive. They're index tracking investments. So if you are an active asset manager whose entire proposition is, please pay me high fees because I beat the index, I promise with my hand on my heart to beat the index, then it's very difficult to say, oh, and by the way, but if you don't believe me, I've got these passive products on the side that you can invest in. So, and it's also an issue of setting up the entire infrastructure, the entire administration, gaining experience. I mean, we have over 13 years experience in managing these ETFs and the special skills and the systems infrastructure, the arrangements with market makers. It's a very complicated setup, much more complicated than what we used to in South Africa, which is why I think they're really only 2 players in the space, which is Sygnia and Itrix. Your tax-free savings account, absolutely, you can invest in the ETFs. But tax-free savings accounts, you could always go 100% offshore. So tax-free savings accounts are neither here nor there in terms of whether these are classified as domestic or foreign. If ETFs are the best option at present, why offer both an ETF and a unit trust representing the same basket items? Good question. Exchange traded funds, until now, when we are talking about them and suddenly everyone will become an expert in ETFs, they were regarded as specialist products. Not many people understood ETFs. Most people migrated towards unit trusts as the product of comfort, something they know. Many financial advisors don't know what exchange traded funds are, or don't fully understand the dynamics of it. So there were literally different market segments that we were addressing by launching the same products wrapped in a unit trust wrapper and in exchange traded fund wrappers. But I think now that this has happened, ETFs will become the household name, in which case there won't be a point in running 2. is there a possibility that National Treasury will implement prescribed assets? Yes, is the answer. They have been at pains to say that they won't. They have been at pains to say that they will rely on boards of trustees to make the right choices for the members of their funds. But at the same time, we're facing some very stark realities in South Africa, which is unemployment, crime. We need to launch large-scale infrastructure projects. Never mind we need the infrastructure, but we need to employ people. And hence, potentially, there will be amendments which will guide the investments towards funding of government or funding of infrastructure projects. Never say never. It's not on the table right now. So let's be clear. Everyone has been at pains. ANC has been at pains to say that this is not on the table at the moment. Even the budget speech at pains to say infrastructure investments will be driven by decisions of the boards of trustees and not prescribed. But, looking at the situation, looking at this credit rating downgrade that we've just faced, which came out of the blue and was very significant, I think there's an increased possibility. But you know what? If someone said to me, okay, you can now invest, I'll introduce prescribed asset requirements. I want you to invest 25% of your RA in South African government bonds and infrastructure projects. And in exchange for that, the other 75% you can hold offshore via ETFs. I'll take that deal anytime, over and over again. So there's question about how much do we charge in fees. Please go on our website. We also are negotiable on fees depending on the size of assets that you're investing in the ETFs, and the ETFs have a sliding scale, but it's all in the marketing and fund fact sheets on sygnia.co.za website. What do I think will be the impact on current listings on the JSE? You know what? Current listings on the JSE, I think it will be marginal. At the moment, there are so few investable shares on the JSE. There are around 48 or so shares that you can actually invest in as a pension fund. Everything else is illiquid and small cap. That, if some money gets diverted from Naspers, or if some money gets diverted from many companies, from BET, which has literally no operations in South Africa, or from some other giants which have no operations in South Africa, what do we care? The JSE is literally dominated by 5 or 6 counters, which account for 50% of the JSE. So I actually think shaving off some of that exposure and reallocating it to diversified basket of international shares is in the benefit of everybody, including the JSE. And if this change attracts more liquidity and more money to the JSE, so much the better. When will you offer Cetrix? And we offer those ETFs at the moment. So Cetrix, One Invest ETFs. I think we offer Cetrix ETFs on our platform as it stands at the moment. I'm not so sure about One Invest. I think they might be there, but our platform offers access to all exchange traded notes and ETFs. The One Invest ETFs are very new, so we might not have switched them on. And obviously we will only offer access to products where there's demand, because there's no point in running the administration around daily unit pricing, feeding in data into your platform. If there's 1 or 2 investors who invest in a particular product provided by a third-party provider, and we have to do all the administration around, say 100,000 Rand investment with a third-party provider, and just the administration alone costs us 500,000 Rand a year to administer that product on our platform. So it needs to make sense commercially. Will an investment made in the same product, ETF, unit trust, grow at the same pace? Yes, it's essentially the same investment. Okay, so again, there is demand for an example where you can get 100% offshore. Please consult your financial advisor. I can't emphasize it enough. I mean, obviously, I can design a product which would be 100% offshore, so switch your 25% bonds. That wasn't advice, by the way. That was just a random example. But you could take 25% SA bond exposure, convert it into I think Itrix has a bond ETF, global bond ETF, and that would get you to your 100% offshore. But again, that wouldn't, I don't think that would be my best advice. Please clarify, do these changes now also make it possible for local trusts to, yes, so local trusts can now invest in these offshore ETFs with complete freedom. So again, to clarify for retail investors, are we saying it's possible to add an ETF product to an IRA without breaking Reg 28? Yes. Do I see growth in new inward listed foreign ETFs? Yes, I do. I think more products will be launched. I'm just scanning through because I see people are dropping off. There's only, but still 400 people hanging on. But I'm almost at an end. Objective, looking at it from national interest in terms of tax income, will South Africa Inc. in particular SARS be poorer due to this development? No, I believe SARS will be richer. So if, savers were retiring with more money, if people were literally retiring with more money and spending more money, then remember that you've got direct taxes, you've got indirect taxes, you have management fees that are taxed. So, if your savings spot in South Africa was greater as a consequence of the ability to diversify more broadly than 48 shares on the JSE, many of them which have operations offshore and have shifted their earnings offshore, which is what SARS is looking at, by the way, transfer pricing and shifting of earnings to lower tax jurisdictions. I actually believe that our tax revenue will be higher. I think if you can encourage people to stay in South Africa, if you can encourage people to keep money in South Africa, if you can encourage people to invest money in South Africa, because you don't have crazy foreign exchange controls and you don't have this mad rush and panic to take every cent that you possibly can offshore and keep it in a bank account overseas, just in case something happens and you have to run, because that's the mentality on the table here. I think that, what both SARS and South Africa Inc. would be richer. So remember that South African companies have other sources of capital. So together with, so apart from the fact that they obviously list shares on the JSE, in order to raise capital, they can also list bonds, they can borrow, both simple borrowing from the bank as well as listed bonds. And yet another foreign exchange control relaxation that has come in is to allow South African companies to borrow money in foreign currency bonds, in foreign markets. So simultaneously with this development, another ex-con control change has allowed South African corporates to borrow money offshore. That's also a biggie. So no, I don't believe that South Africa Inc. will be poorer. I believe South Africa Inc. will be richer. And if you've got richer consumers, they'll be buying more services and more products from South Africa Inc. Negative, there is no STT on ETFs. There's a question about whether transfer tax, securities transfer tax applies. There is no securities transfer tax on ETFs. The new ETFs are offered within tax-free savings vehicles right now. When will the new Sygnia investment platform be launched? Brilliant question. I'm going to keep asking FNZ. You might have seen an announcement recently that FNZ has acquired Silica from 91. Silica is the largest provider of Lisp software in South Africa, and we have worked with FNZ for 3 years. They were supposed to deliver a new technology platform 2 years ago. They have now purchased Silica, and I can no longer scream. I have screamed so much, and it still haven't sped up the development of the product. But in the meantime, what we are doing in terms of platform development is we have relaunched our own platform development to ease the administrative burden. So please bear with us. We are flooded. Even before this development, we had enormous amount of new inquiries and money switching to Sygnia. On the retail side, we're hiring as quickly as we can. We do understand that there are some administrative delays in the system. I promise you, behind the scenes, on the surface we swans, behind the scenes it's pedaling as quickly as we can. And we're also developing workflows and not placing as much reliance as we were on the international providers. We are now back into taking care of ourselves. And thank you to everyone who's saying thank you. And I think on this note, let me bring this webinar to an end. I think it's been a very lengthy session. Thank you to everyone for listening for as long as you have listened. As I said, it's not impossible that FSCA comes in and adjusts Regulation 28. And you have my undertaking that if we believe that those adjustments, any proposed adjustments, are not in the best interest of South African consumers and our investors in particular, we will fight as hard as we possibly can to ensure that South African savers benefit from this change, and that everyone retires wealthier, more prosperous, more comfortable, and feels more comfortable about living in South Africa generally. So thank you again, stay safe, and goodbye.